Hi everyone, a very good evening and a very good Friday to all of you. Today we are going to try and make your Friday a little bit better with a very interesting guest that we have with us today on today's webcast. Also, guys, this is our first webcast of the new financial year of the second season of Fisdom webcast. So cheers to all of those returning viewers and a very warm welcome to the viewers watching this for the first time. So, guys, today with us we have an interesting guest. We have Mr. Vishal Kapoor. He's the Chief Executive Officer at IDFC. He comes with a rich experience of over 2 decades in financial services across business functions, including asset management, banking, consumer marketing. And he has an impeccable track record of building strong teams and sustainable businesses. A very warm welcome, Vishal. It's a pleasure having you on the show.
Thanks for having me, Nirav. It's a great pleasure to be here.
Right. So, Vishal, we are quite impatient, right? We always want to extract the most out of our guests. So, without any further ado, I'm going to jump right into the question that's on the top of everyone's mind today. Market kya bol raha hai? Like, what's exactly happening? How's the economy shaping up? How's the market shaping up? People are worried. People are unable to make sense. On one side, we are worrying about a second wave. We are talking about commodity prices rising, and the pink newspapers are flooded with reasons to worry, but the market is celebrating, right? So, could you just help us and our retail investors make sense of what's actually happening in the economy and how is the market receiving it?
So I think good points, Nirav. And I want to start off with making two very simple comments. Firstly, volatility and market just go hand in hand. So if there is volatility in the market, there's no reason to be surprised. It is just very, very integral part of any market, right? So, to say that, oh, markets are volatile, I just find it, in 25 years, I've always found the markets volatile. So I would be worried if the markets did not offer any sort of sense of direction. That would be such a boring world that we would live in, right? The second is, at some level, any market is really trying to discount the future. It's not about today. Keep that in mind. So the market is always looking ahead. And when you try and look ahead with some basic pieces of information, which is changing, it is very natural that you will have some effect, which is volatility, which is, people developing different views. So we do live in very interesting times, and we've seen that over last year. And, at a time when at maybe a month back, we were all celebrating that COVID is gone, and we've managed to tame this beast, and now vaccinations already started, etc. Things looked like we were really back on track. Of course, with some amount of the wave, the spike actually that we're seeing coming back, as well as a bit of a tug of war that you're seeing in the bond markets between investors and central banks. There seems to be a bit more volatility than what we were anticipating a couple of months back, when it was all hunky dory. Earnings had rebound, the stock markets were looking quite optimistic, and the bond markets were actually looking quite sanguine. So that nature of change may have caused some amount of temporary, I would say, anxiety in the markets. But I can be quite sure that 6, 9 months, 12 months later, we'll all look back at this. Actually, you won't even remember this. This will just be a part of the phase of the market. So I wouldn't worry too much about reading day-to-day sort of volatility into the markets today.
Hello.
Sorry, Neil,
Can you hear?
lost your
Yeah.
audio.
Yeah. So you spoke about something very interesting. You spoke about volatility as a key feature of the market, right? And even I agree, volatility is a sign of life, be it on the market graphs or on the ECG. There has to be some sort of volatility. And had it not been for the volatility, there wouldn't be any profits, right? There wouldn't be any gains. So volatility is important. But according to you, what are the most important, you know, the best way to put it is, what are the most important do's and don'ts for a first time equity investor who is already quite perplexed by the way markets are acting up these days with the volatility? So what are the do's and don'ts for a retail investor?
Right. So I'll stick to maybe just a couple because it's a fairly long topic. So to your first time equity investor, first I would want to congratulate, because you've taken the big first step. And we have to keep in mind it's not easy. whenever you move from being a saver to maybe a fixed income investor or a debt investor or a equity investor, it can be a bit unnerving initially to see your capital go down. So if you've made that first step and you've gone through at least some volatility, it's a great first step. So congratulations for making that. Second, like I said, anticipate volatility. That is very much part of the market. One easy way for new investors to manage volatility is to spread out the investments. And one fatal mistake, almost I would say, you should not try and get into is try and time it. Right? So if you think that you're smarter than the market and you can pick and choose the troughs and the peaks, please stop. Please don't try that. And enough people are doing this, trying to do this 24/7. Hopefully you have a full-time job. Focus on that, and don't try and time the market and unnecessarily generate activity where there is really no great value that can come out of it. In fact, you may damage yourself. So try and stay away from unnecessary activity in a sense. The other, so come through a sort of SIP route or a route where you're spreading your entry points across. The other basics, Nirav, that I'm sure your investors and most viewers would now know about is that in addition to that, keep your goal in mind. I know many people, especially when they start off, really don't have a goal, but that's fine. If you're saving, that's good enough. So first, save as much as you can. Saving when you're younger and that corpus being given a lot of time to grow is a far better outcome than being very sharp and very clear about a goal maybe 4-5 years later and then starting to invest. So save as much as you can. The goals will come. If you're very early in your life and you really don't have any specific goal right now to plan about, so save as much. Once you start investing, keep in mind some of the basics around allocation and managing risks and doing a review and rebalancing only periodically. So keep the allocation at front and center of your review process or your investment process. Don't worry too much about the interim volatility.
Right. So you spoke about something very important. I feel you spoke about timing the market being a futile exercise, and people should not do it. It quite reminds me of one of the quotes of Bertrand Russell. It went on the lines of the fundamental cause of trouble in the modern world today is that the stupid are cocksure and the intelligent are full of doubt. So I feel we have seen this time and again, especially during heightened volatilities, that the experts and the domain professionals that I talk to have only one thing to say, is that I have nothing to say. And this is a part I don't know what's going to happen. They are willing to accept that they don't know. While at the same time, I talk to a fresh investor, a first-time investor. He almost always has a definitive tip on one of these stocks, and he almost knows that this is going to be a multi-bagger, right? So this is the kind of environment where we're living in. And today I see the same thing happening with more and more investors flocking towards opening demat accounts and trying to directly time the markets through investing in stocks directly. I feel certain experiences can be learned only by going through it and not by listening to it. So I just hope that people are watchful and careful about it. It's okay to take it as experience, but not have it as scars that will not leave you with any appetite to re-enter the market again. So an important thing, Vishal, while speaking about the do's and don'ts, you mentioned about diversification. Okay, like quite briefly, in some sense, you spoke about diversification. We would love for you to elaborate upon it. What do you mean by diversification? What do you mean by asset allocation? Let me give you an idea. Today, I am sure most of the viewers here think of asset allocation just as a function of deciding kitna equity dalna hai, kitna debt dalna hai, and they feel that is all diversification is about. But we would want to hear your take and your thoughts on optimal diversification and how does one achieve it.
Right. So I think firstly, diversification is something that is, I did mention that it was one of the most important things. This goes back, actually, this is not just hearsay or this is just not conventional wisdom. There have been studies done where you looked at what are the attributes of a portfolio that really impacted returns over a long period of time. So you could have attributes like, getting the stock right or the product right, getting the timing right, getting the manager right in the context of a pooled investment, getting the allocation right, or maybe sometimes the fees and charges. So if you have like a bunch of these characters that you could optimize and say what actually impacted my portfolio returns over a long period of time, quantitative studies have proven that 90 plus percent of your portfolio's eventual return over a long period of time can be attributed to the single factor of allocation. So if all the other things around timing and getting the stock or the fund manager was not right, was not optimal, but you got the optimal allocation, you would still probably get 90% plus of the eventual returns. That's what mattered, right? Now, in my experience and my humble observation, I see most of us investors doing the exact opposite. So we probably spend 90% of our time thinking about all the other factors that I just mentioned, right? कौन सा stock है, आज लूं कि कल लूं, इसका chart देखते हैं, and this fund is more expensive than that, and let me go to the cheapest one, etc., etc. And we probably spend therefore the balance 10% of our decision making time figuring out ki how much equity, how much debt, and how do we split those proportions. So the Pareto principle or the 90-10 in this case works almost the other way around. You should be spending the bulk of your time thinking about your allocation. We mostly, at least I initially used to spend a lot less on allocation and used to spend a lot more on the exciting stuff, right? कौन सा stock है, क्या भाव है, all of that. So that's very important to recognize that the bulk of your investment outcome will be influenced by the allocation that you're in, not necessarily by the individual picks and what you got successful and what you got wrong. The reason for that are many, but at a very, very basic level, I think we've all heard the phrase that don't put all your eggs in one basket. All your eggs are in one basket, something goes wrong, all your eggs are broken, right? So if your money is the eggs, you have to split it across different baskets. In the world of finance, the reason for that is not because it's just getting broken, but also because things move in different directions at in different speeds, what we call correlations, right? So sometimes what happens is that if you have the full basket, let's say in equity, it could all be coming down or going up at the same time. And if it's unfortunately coming down at a time when you needed the money, you are left with a lot of pain, right, which you want to minimize here. If you also had some money at the same time in, let's say, bonds, and in general, if you think that they are negatively correlated, so when equity comes down, maybe bonds are doing much better. So at least that part of your portfolio, not only is it safe, but actually that can be doing much better. And then you can add other asset classes like gold or real estate, and there are others. Even within these big asset classes, there are other subdivisions one can look at, right? But that's for a later day. So the point is, if the bulk of your outcome depends on this one feature, and two, it moves in different directions, it keeps you safe, it keeps you out of trouble, then do spend a lot of time on this, much more than behaviorally we see people spending on this.
Right. So as long as we're talking about allocation, I really need to ask this question. There are two schools of thoughts, okay? One, and this is for a specific situation. It says if I have to invest for a long term, okay, let's say 10 years plus, through the SIP mode, why should I allocate anything to debt, as I know in the long term equities will always be the outperformer? So does asset allocation apply there, or will it be detrimental to my long term portfolio? So what are your thoughts on this?
So I would be a believer of unconventionally saying that you should also have an SIP in debt. There's nothing wrong in that, because keep in mind, plans change, and that's the unfortunate truth, but it is the truth. So you do think today that you can afford to keep this money 10 years, etc., etc., but life is going to keep changing. We just spoke about volatility, which is coming out of the fact that your outlook of the future is changing. So I would say, look, maybe be a bit more humble and recognize that even the best of your laid plans may need to change. You really can't forecast what your need for money, what your circumstances will be. So to be so damn sure that I'm not going to need my money, I would say, look, step back and take a deep breath.
Right. I
If you
mean,
go with the
yeah,
yeah,
please,
sorry,
please.
yeah. So don't underestimate the need that money will also there is a benefit of having flexibility. In the financial world, we call it the price of an option. So you do need some amount of flexibility. The fact that should you need money, and I'm not saying that plan for this, there are other ways to plan for emergency corpus, etc., which I'm sure a lot of your viewers have already, been thought about. But even for the 10-year period, if you're saying it is only equity, I'll say, yeah, your belief is that equity will do well. It generally has, but there have also been periods of time when actually bonds have outperformed equity over 10 years. So it's not impossible for that to happen again. A lot of this is based on the past, and then every historian will tell you that if I knew that history repeats itself, I would be a great investor, but that's not the case, right? So we can only learn from the past. You can't exactly extrapolate that into the future, right? So who knows what is going to happen? This is generally the belief that we have from the past. So if you recognize that things may change, then having an allocation which provides a bit of that balance is maybe a more sensible way to go. And for that, a lot of people say that okay, equities के लिए तो SIP कर दिया, right? Debt is often the leftover, and वो leftover के लिए I'll decide later on, generally through a lump sum, or what I want to do with that. And there, our simple point is that look, if you can do an SIP in equity, why don't do the same in debt? So if you've decided, let's say as an example, that you want a 75-25 allocation between equity and debt, right? To take the 75 into SIP and take the 25 as lump sum, why does that make a lot of sense to you? Why not just take the entire 100, split it into 75-25 equity debt as an SIP? So you're always reasonably sure that your incremental savings is going in a certain proportion. Of course, that will change over time because they'll grow at different rates. If you want to rebalance periodically. That's fine.
Right. Makes a whole lot of sense. If anyone were as sure about his or her future, I feel we wouldn't have to worry about almost anything in life, right? I mean, all that's left is us having a crystal ball and solving the world's problems. But sadly enough, I don't think any of us have that, can claim to be that sort of a clairvoyant,
So one point I just want to quickly make, Nirav, here is that, and you'll notice that in finance, especially over the last maybe 20-25 years, there's been a lot of, especially in personal finance, right? There's been a lot of thought around behavioral finance, right? And we've combined these two disciplines of finance and behavior, a lot of psychology to understand how the human mind works, because we keep seeing and we keep learning that we are making conscious mistakes, unconscious mistakes, etc., all the time, right? And going back to your earlier point, it just struck me that as a reaction to volatility or some kind of stress, right? It is very natural in the behavioral science world for people to do something, right? It's called activity bias. Now, as the scientists tell us that this is coming out of our brains, which are really still in the world where we were hunter-gatherers, right? And in a hunting-gathering sort of environment, if you did not react to a stimulus like some rustle in the bushes, you were eaten up. You were out of the race, right? So your survival depended on reacting quickly. Those who reacted to stress survived, and they formed the race and the gene pool that we are out of. And those who were very adventurous and who do not react to any stimulus were eliminated. So to some extent, we are wired to react to stress by doing something. Unfortunately, we moved on. We are no longer in the hunting gathering phase. We are in the world of finance. So stress leading to reaction in finance may not give you the same benefit that it gave you in the past. So all I'm saying is recognize that some of these biases are hardwired. It's very natural for us to react. Don't feel alone if you're doing that. All of us still do. But it does not mean that it ends up with a better outcome for you. So just recognize that and be conscious of any of these biases.
Right. I'm glad you spoke about the action or activity bias, as you call it. We have been quite, supportive of blending the studies of behavioral finance along with conventional investing. And I feel the root solution lies in people believing that inaction is also a conscious action. If you feel stress and you feel a need to react, you must understand that not reacting is also a form of reaction. Might sound counterintuitive, but let it seep in for a second or two, and you'll realize that it's a conscious decision. And when you make a conscious decision, it is an action. Okay, even not acting is a conscious action. So I feel, for all the viewers out here, very much in line with what Vishal said, it is okay to be reactive, but take comfort in the fact that not reacting is also a form of reaction, and that you need not always get into the fight or flight mode. It's अगर कुछ स्टॉक में हलचल हुआ है या आपके फंड के एनएवी में मूवमेंट हुआ, you don't need to fight or flight. You don't need to sell it off, or you don't need to keep buying to average it. Sometimes it's okay, just let it happen. Volatility is the nature of the beast, and that's, I feel you should take more pleasure in enjoying the roller coaster ride that it is. I know it is cliched, but that's how we can put it, right? So a very important thing, when we are talking about the roller coaster, it reminds me of the most exhilarating moment is when you're at the top of the entire ride, right? And I feel that is quite analogous to where investors are sitting right now in terms of the market cycle. Okay, we are almost at the top. Investors are exhilarated. They are confused. They're worried. They're thrilled. They don't know what to do. So, what is your thought or opinion that you'd like to share with our investors who are still worrying about whether this is a good time to invest into equities? Is this too high, or what's really happening?
Nirav, to be honest, I've come across many investors over the last year who were very, very sure that it's the top now, all through since June and then July and then the August and September and October, November, and when the Sensex crossed 50,000, everyone said, "Oh, that's it. This is crazy. This is definitely the top," and promptly it came to 52. So the point is, of course, we have the benefit of hindsight now, and that's not fair as a comparison. But I would ask you again, how do you know this is the top? How are you so sure? Yes, of course, there are signals that you should be wary of, like valuations are stretched. Absolutely, right? But again, they have been stretched for quite some time. Maybe there are things in conventional wisdom which is not working, which, as you look at valuations around in certain new industries, it doesn't seem to reflect the conventional wisdom of how valuation is done. So there are many things around us which are changing. So once again, I would just caution and say, look, don't be so sure about what an outcome would be. I'm not saying that disregard conventional wisdom and don't be cautious. Yes, by all means, be cautious. Right? But to say that, oh, actually, we are absolutely at the top, let me sell everything and sit tight. Many people may have tried doing it over the last year, and look where we are, unfortunately for them. The second is, we may be oversimplifying the market a bit, right? So if you look at the market for last year, and I'm just looking at, let's say, from the bottom of March 20 to Feb end, by and large, right? So yes, Nifty has done very well, probably 80, 90+% return. Mid and small caps have done even better. So 120, 139 odd percent return for mid and small caps. So it looks extraordinary. And yes, it is, 100, 120% return in a year is fantastic. But if you take a slightly longer view, and this going back to the last peak of January 18, so if you remember, January 18 was sort of the end of the last bull rally, where after that, through 18 and 19, there was a market which was very polarized. One part of the market, the absolute top end, some very concentrated large caps did very well, but the bulk of the market, the broader market, corrected very steeply. So if I just take the horizon to the last 3 years since January 18, what you'll see is that it's not that pretty a picture for some parts of the market. So like I just said, the narrow view of the market may be 130, 140% return in mid and small caps. The 3-year view of the market will show you a different picture. Actually, mid caps have just done maybe 10% or so. It's not a lot. Small caps at an index level are actually negative. So it's not even gone back to the level that you were about 3 years back. from a return standpoint, from a net return standpoint. So don't oversimplify the market just looking at the index. Yes, it's a good measure, it's a good way to sort of generally keep track, but there will always be pockets of the market which will offer value, and there will always be pockets which are, in that sense, overvalued. So, to say that entire market is overvalued, maybe stretching it. Having said that, be very cautious, look at the signs, but go back to your allocation. Are you under allocated to equity? The answer, if it is yes, then you have to get a bit more. If you're over allocated because you've got these gains, it may be a good time to prune. So just go back to basics.
Right. Towards the end, it was quite the moot point made, right? Stick to basics, stick to financial discipline, stick to asset allocation. Asset allocation is king. You stick to good asset allocation, it will solve most of the worries. And for viewers, who are wondering if now is a great time to invest in equities or not, I feel, just to sort of give a very crude line of thought. If you believe in the long term, let's say you have to be a long term investor, point number one in equities. And let's say in the longer term, 10 years plus, you believe that the world economy will be in a better position than it is today. And if you believe that that economy will be created by companies, there's no reason for you to not own shares of companies, right? So obviously, you may get a few right, few wrong, but that's where you take help of professionals who are breathing this day in and day out and are more equipped to take better decisions. You can take help of professional fund managers and professional management teams like Vishal has at IDFC, AMC, and several other AMCs do have, and invest in great mutual funds to make your long term equity investing journey a bit more rewarding, a bit more uh, let's say efficient in a way. So Vishal, a very good point that you made, that people seem to be simplifying, just by simplifying the market just by looking at the index. In fact, I would like to take it a notch further and make the blame all the more painful and say that there is a difference between simplifying and trivializing. I feel most investors at this point seem to be trivializing the entire situation that's developing in the market. I'm okay as long as they're trying to simplify, but trivializing is not acceptable. But while we're talking about simplifying and trivializing, it brings me to another topic that's not so simple and also not so trivial. It is about the fixed income space today. So standard disclaimer, I'm not going to be talking about the rate reversal that the finance ministry has done. I'll leave that for some other day. But we realize that overall, interest rates are dropping, right? We are investors are not able to get the returns that they used to get on their fixed income instruments like fixed deposits, for example. And most of them are absolutely clueless as to how should they take any exposure to fixed income mutual funds because of the complexities involved and the only scary headlines that where fixed income features, all about credit default and durations and yields and all such confusing jargons. I feel people who are looking to allocate a portion into fixed income are now lost and are unable to find choices. Could you just guide us on how could they, get some clarity on this part of the decision?
Right. So, Nirav, yes, a very wide and a very interesting topic. One or two things to start with. Firstly, let's recognize that the average Indian saver still has probably 3 to 4 times the money, of equity in fixed income. So, fixed income is the bulk of your asset pool or the savings pool. When you combine all forms of fixed income that you have, whether it is retirement saving or your bank deposits, etc., etc., that's very clear from the aggregate data that the average Indian saver is really a fixed income investor rather than an equity investor, by and large, right? So it's a very large pool of assets, and therefore one has to be very careful about how we go about looking at it. Second is it's a complex area, and we must recognize going through a period of relatively low inflation that the country's never gone through, right? So ever since our independence, we've generally been in a highly high inflation and therefore high interest rate environment. Therefore the conventional wisdom that good rates, in my parents' generation used to be always double digits, and then we got used to high single digits. So conceptually, nominal rates which are low single digits is not acceptable. It's happening too fast for us because we've never seen low inflation rates for a elongated period of time. So it'll take some time for us to get used to low inflation rates and therefore low nominal interest rates. And there's nothing wrong in that. It's just that something we have to recognize, right? So you can't expect, let's say as an example, maybe if you look at 8-10 years back, inflation rates, if I look at CPI being double digits and you getting 8-9% bank deposit rates, you must recognize you are losing money there. If CPI was 10 or 11 and you're getting 9% in a bank deposit, you're losing money, right? You're not even beating CPI. Now when you have a situation where CPI had been quite low, WPI was negative, and it's now rebounding, to get maybe 4, 5, 6%, you're actually making good positive returns. Nothing so wrong about it conceptually. Of course, at a headline level, you feel that you're making only 5% versus 9%. So recognize the real nature of returns. It's not so bad. That's your second area I just want us to think about. Third is, you spoke about people are confused about, mutual fund volatility, NAV, this and that. The nature of a mutual fund product actually reflects price and interest rates movements immediately. So the same thing may be happening in other products, you just don't recognize it. So you recognize it when you have to reinvest. So you bought yourself a deposit and you locked in the money. And when you have to reinvest it, then you realize that, actually deposit rates have come down and now I have to reinvest it at a lower rate. In a mutual fund, those rate exchanges or adjustments happen real time immediately. So you feel a lot more volatility, but it's not fundamentally any different. The nature of the interest rate markets is the same. It's just that we are pricing it immediately and therefore you feel it is more volatile. If you were to hold on all of those conceptually to maturity, you would get the same return or similar returns. So it's just interim volatility. It's a lot of transparency. It's not inherently more disadvantages in a sense, if I can put it that way. Having said that, because it's a very wide area, what at IDFC, what we've been seeing and what we've been advocating for some time is to maybe look at your fixed income investments into 3 buckets. And doing that, what we are also recognizing is that most of our savers, most of our investors actually look at fixed income under the safety bucket. This is not the money that you really want to put a lot of for growth objectives. Like you mentioned earlier, if I'm investing for 10 years and I want growth, why not put 100% of my money in equity? Yeah, fine. If it doesn't happen, it's a risk, which is what you're willing to take. Your fixed income pot is largely to keep money safe, to absorb shock, right? Should something else or adverse happen to the other part of your investments, which is in equity, right? So if safety is a prime concern, you have to recognize that has to be the bulk or the core of your fixed income bucket. And if that is the objective, then the core bucket, which is where the bulk of your savings or fixed income investments should largely not take a lot of risk, whether it is in the nature of credit risk, which is buying things which are less, let's say, credit or not as well credit rated or good credit rating, or taking duration risk, which is it may take a view on the rate change or interest rate movement in the future, right? So keep the bulk of your money into safe, short to medium term or really duration products, which buy into the best quality investments like AAAs or government securities. You also have an emergency pot which is required, where fixed income can actually have a very good play. This is money that is needed for immediate use. Obviously no risk to be taken, no duration to be taken there. You're happy with whatever the sort of overnight rates are. And overnight funds and liquid funds are generally a good way to keep that money, emergency funds, right? And that leaves us with the third bucket of money, which is what we would call the satellite bucket. Now, the satellite bucket is where you're actually trying to take a bit of risk. Because keep in mind, there are opportunities in the market. It's not as if fixed income does not throw attractive opportunities. So when you look at the satellite bucket, you're there taking a view on what is likely to happen over the next 3 to 5 years or the next cycle. And there you can take a bit of risk, whether it is riding the duration curve if you think interest rates are going to come down, or riding the growth curve if you think that there is growth going to happen, and maybe you want to take a bit more credit risk in that environment. That can maybe give you a slightly higher return than your core bucket. So if you think about your money in these three buckets, we think that it will help resolve some of the dilemmas that we face about should I take something with a high YTM, or should I take something which is very, very low duration, or should I, how do I mix and match? Sorry, long answer to a short question, Nirav.
No, 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 please. So, yeah, yeah. So, we have spoken about a couple of interesting topics, and most of it revolving around the concepts and basics of investing, right? Like how important diversification is, how important asset allocation is. And we cannot complete it without talking about the concept of goal-based investing. So we recognize that you have been a steady advocate of goal-based investing. Could you please elaborate around how could one go about goal-based investing?
Right. So the reality, Nirav, is that when we start, like I said earlier, right? If you don't have a goal, don't fret. Save as much as you can till your goals emerge. Especially when I find, as we get started with our careers, we may not recognize an immediate goal, and then we want to spend away a lot of money. But keep in mind the value of that savings very early on over the next 20, 30, 40 years is humongous from the power of compounding that it gives you. But once you start looking at, you know, your life ambition or your plans for the future, a lot of your financial needs can be completely and very closely aligned to your goals in life. Right? Now, these could be spread across short term, medium term, long term based on how you're looking at it. So, as an example, right? If you are looking to, take a vacation in a couple of years, one way out is, of course, when I get to that, I take a loan and then repay it off. That's a very expensive way to do it. Another way is that if you plan in advance and keep saving for it, then you can have a pot of money available and a budget available for you to take the vacation. So that's an example of having a goal in the future, saving for it, and then using it up when you reach there. So there are similar ways in which you can plan for life events like that. The two or three big life events in most people's lives, one, of course, retirement, the biggest one that you must start planning from the beginning. There are many common errors there. People don't realize that with life expectancy going up, and a lot of people wanting to retire early. No one wants to now work till 60. I have a lot of people, my colleagues, who want to retire at 45 or 50, maximum 55, right? And there are enough who want to retire before 40. The fact is that if you're going to retire at 40, 45 and live up to 75 plus, there's a lot of period of time to finance from your savings. And that's something that you'll need to plan for. Otherwise, there is the fear that you will run short of that saving. And what do you do then? Right? So that's something you don't want to put yourself into. So retirement is something that is, of course, an obvious goal for everyone. Then there are, if you have a family, then there'll be marriage events for your children. There'll be education funding for children. Maybe you need to, buy a house. Now you can always take a house and then pay it off. But, there'll be other investment opportunities in real estate that will come through. So there are these type of life goals you have. Now, for each of these, recognize that your risk appetite as well as the time that you have for that is different. And therefore, it is likely that the allocation of the investment strategy for each of these will also be different. So therefore, instead of having one large bucket of savings and managing it as one pool, it may be easier for you to identify these into different goals and then manage towards that goal. So your liquidity considerations, your risk appetite, and how much corpus you want to build can become much sharper. You'll remain more disciplined as well. And that can, in general, lead to a much better outcome than not having a clear idea about where you're going.
Right, right. As we move towards the fag end of the session, there is one thing that we wanted your thoughts on. So this entire pandemic has, created quite a shift in markets as well as investing behavior, right? So according to you, would have observed a lot many investors behave in a lot many ways. So what are your learnings that you'd like to share with our viewers that you would have learned during this entire pandemic phase, and more specifically around investor behavior?
Right. So, Nirav, firstly, I think, as we got into the first phase of the pandemic and everyone was locked down, and I think a lot of us felt after the point in time of working from home or being locked in that, the basics of life are quite simple, actually. We don't really need a lot of the trappings that we, get enveloped in when you come to a day to day living in your house. And I think it may be true of our portfolios also. And maybe your portfolio has a lot of what I would think is almost clutter, because the mistake we may make is that we think that by adding more products we are diversifying our portfolio in some sense, right? And I've looked at enough portfolios where you may have 20 different investments, whether it is funds or some form, but the actual diversification you achieve is not much, because all 20 are trying to do pretty much the same thing or based on the same idea, right? Which often happens in our industry as well, where keep in mind that if a certain style or a certain type of idea works well, right, everyone buys into the same style multiple times through different types of funds, not recognizing that it's the same idea that works. So that's not leading to a lot of diversification for you. It's just repetition of the same concept multiple times. So don't equate the number of investments that you have in your statement with diversification. You could be actually far better diversified by just having one or two funds, especially if it's a balanced or a balanced advantage type of a fund. You could be very simply achieving great smart diversification through one fund, which a 20 fund portfolio may not be able to achieve. And therefore, don't confuse clutter on the investment statement with actual diversification. Keep it simple. If you keep it simple, your ability to track things that actually matter may be a lot more. So this is just a bit of the reflection from the frugality of living within the house for some time. That dal roti is what you actually need. A lot of what we otherwise have is maybe not. It's nice to have, but it's not necessary. And maybe take a bit of that thought into your portfolio as well. The second is, I think, something I mentioned earlier, Nirav. Let's not get ahead of ourselves and believe that we know it all and we can predict everything that is happening. And it is very natural when times of stress happen, like in March last year or April, when in the market all things were going wrong and a lot of volatility. I really felt that people doing things like stopping the SIPs without knowing what will they do with that savings that is going to come in any case. It's not like their earnings was impacted, right? But say, no, 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 I think there is, market will go down further and I'm going to stop this. Or not getting back in the market, trying to time it. So, I would say stay humble. As they say, stay humble, stay foolish. But stay humble. You, you know, trying to time the market, trying to predict the market, etc. If you have a long-term goal that we just talked about, it's just going to be futile, right? It's a reflection again from how many people in maybe at the beginning of the year when we had when we crossed over into 2020, imagine what the year would be like. So recognize that you can't really predict some of these events. Don't try it. In the market again, trying to predict that this will happen in the short term. Don't even try it. Stick to the long term. Maybe you need to take some decisions on the fly based on what is happening. But by and large, if you stuck to the discipline of allocation through this period, you were very well served. In hindsight, what was calendar 2020, if you think about it, or even fiscal 21, which is ended 2 days back, was anticipated to be the worst year on record, right? Because of the economic shock following the pandemic. But from a market standpoint, I don't think I don't think any investor should be complaining with more than 100% returns in different parts of the market, right? So the expectation at the beginning versus the result at the end, I think that can be a huge contrast. And this is something that this year just showed us. This should be a learning we should really ingrain for the future.
Right. Very well elaborated. So, as we move towards the end of the session, our comment section, as always, is once again full with a number of questions. So, we are going to pick a couple of them and would love to hear your thoughts on that. So, the first question is what are the potential risks to the economy that you think investors should look out for in this financial year? Okay, very specifically putting it to this financial year, but in general, what are the risks that one should watch out for?
Right. So there are quite a few on the anvil that we have to be careful about. Firstly, from a market standpoint, there is the fear of inflation, and because of that, how do interest rates react? So there has been, as everyone understands, a lot of fiscal and monetary support over last year, and almost unprecedented levels of support, which has led to a lot of debt in the economy. Right? This is largely borne by central governments and by bankers. Now, the question really is that you're supporting growth. Does inflation come in line with that growth, or is there a spike in inflation because of this excessive spending that is going on, a stimulus that is going on? So it's really a bit of the order in which this unravels to some extent, and that's a bit of a push and pull between the bond markets and the central banks to some extent. The central banks, I would imagine, would want a very gradual and normalizing of the yield curve, even if it has to, unwind over a period of time. The bond market may anticipate or fear or worry about a bit of a spike, which may lead to trading opportunities or, something that you want to cash out on. So that may be going on. So you have to keep an eye out for what's happening on inflation and what happens to bond yields. Following that, what happens to liquidity, which has been one of the triggers that led to the sharp increase in equity markets across. So if liquidity dries up, FIIs go back out, then you should anticipate a correction in the equity market. So that is very, very normal. Now, part of this is also impacted by the recent resurgence of COVID. Keep in mind, just about 2-3 months back, we were all celebrating that COVID is back. There was some hypothesis that maybe India has already achieved herd immunity, and then the good news of the vaccines. And in fact, the very fast rollout of the vaccines, where starting at least yesterday, people like me can also get covered under the vaccination program. So that is all very, very good news. While that is happening, there is still the fear that the spike is unprecedented, and will it have a lot of economic damage? Now, much of the market may still believe not necessarily for now, but that's the cause of worry. But looking more globally, keep in mind there are pockets like the US where vaccination has been very quick, and therefore confidence of economic recovery and not having too much of a drag because of COVID is much higher. The confidence is much higher. But then you have Europe, which is still struggling. So economic recovery there may be a bit more delayed, and therefore you will have a mixed bag in the global or the developed world for economic recovery. These create these pulls and pushes, which may not allow you to to have a steady state view of the market. So volatility will continue, like we spoke about at the beginning of the year. These are some of the risks we have to watch out for. Valuations are high, keep in mind, and with high valuations supported by high liquidity, if liquidity were to dry up, there'll be enough reason to say, look, we told you that these very high levels of valuation, how can you justify it? Valuations are based on expectations of the future. Last quarter, India had, most companies delivered very strong results. This quarter, again, is expected will be quite high. Some of the leading indicators are very positive. So the cyclical upturn does seem in place, but volatility will continue over the next year as well.
Right. Right. So I feel you have given him more to worry about. So these are the risks that you should
Good for him.
be watchful of. So coming to the next question, I think it's quite related to, I mean, this is the flavor of the season. So what are your thoughts on passive investing?
So I think it's a very smart idea if you want to save cost. And if you don't want to tinker around too much with sort of different styles and different ideas that human beings can bring in, right? So if that's your objective, that you want to save cost, and your belief is I'm happy with an index or I'm happy with a certain set pattern, then by all means go for it. Having said that, there are enough, I think, believers of the active plan or the active strategy even now, because keep in mind the index end of the day is an outcome of what is going on in the market at different points in time. And there are enough believers who say that when the true value increase in a company happens, and this is, I'm talking about the equity world, it is not when it is already in the limelight. It's often when it is a small cap becoming a mid cap and then eventually becoming a large cap, right? So the big change happens when it moves from small to mid to large. Once it's already large, it may not give you that amount of an upside, right? Which is when it starts getting included into the various indices. So there's one school of thought which would say that the big value jump is already behind you by the time it gets into the limelight of being included in an index. So it then comes back to what's your risk appetite, what's your variability, and what's your objective. If saving cost and being happy with the index type returns is what you want, then it's a great idea. But it doesn't mean that there is not enough value in the active managed products who are trying to find some of these other hidden gems and hopefully getting it right over a cycle.
Right, right. So the last question for the day, Vishal. What are your thoughts on international investing? Is the diversification worth the additional risks?
So diversification is always a good idea. I would say yes, you should go about investing. International diversification, gives you the additional benefit of currency diversification as well. Keep in mind that the investments are not in your home currency, and therefore, apart from industries and geography that you've chosen, there's a currency play there as well. So at multiple levels, it does add a lot of diversification to a purely Indian focused portfolio. But having said that, Nirav, something you mentioned, you would normally want people to be comfortable with where they're investing. And, a lot of people really are not as comfortable about not knowing about what is going on in the country or theme or whichever way you've looked at the international portfolio. So at an aggregate level, if you do want to add more diversification to your portfolio, I would say it's a great idea. But be comfortable that you may have gaps in knowledge, or you may not anticipate the type of moves that may happen in different countries because you're not watching it as closely as you're watching things in India. So just be comfortable with that gap that you have. But in aggregate, it's a great way to diversify further. Yes.
Right. So this brings us to the close of the conversation. The time really flew that fast. I was all absorbed into the conversation. So it has been a wonderful conversation, Vishal. We move towards the close of the show, and I want to really thank you for taking out time today. I know it's a Good Friday, but I hope this your words of wisdom have made has made our Friday a little bit better. So we have a Good Friday and a Smart Friday at the same time. So thanks a lot, Vishal, for your time and your words of wisdom. It is really valuable and much more than we had bargained for. It's really helpful.
Oh, thanks for having me, Nirav. It's a pleasure to be on your show. And as you rightly said, let's hope it's a good and smart Friday, and you have a great long weekend. So enjoy the rest of your Friday, and to your viewers, and the Saturday and Sunday that's coming up.
Right. Thanks a lot, Vishal. Thank you.
Thank you.
So, guys, this was Vishal Kapoor, the CEO of IDFC Mutual Fund, and it was an interesting conversation. There were pearls of wisdom strewn all across the conversation, but I'm just going to jog your memory a bit. I'm going to give you a quick recap of the most important highlights of the conversation. The most important thing that Vishal stressed upon time and again is the importance of diversification. And in response to one of the questions that we asked, he also made it very clear that diversification does not equal to the number of funds that you see on your statement. Just because you have more number of funds or instruments or securities, it does not mean you're truly diversified. Diversification needs to be done at an idea, at an asset class, at a theme level. So you can achieve optimal diversification even with just a handful of funds and handful of stocks per se, versus just having 40 odd funds who are all revolving around the same theme. So true diversification, true being the keyword, is an important thing that you must seek while investing. The second most important thing we spoke about is asset allocation. So asset allocation is king. That's the cliche, phrase, but it holds true and will hold true for times to come. Ensure that you stick to optimal diversification and stick to asset allocation. This will solve most of your decision making problems when it comes to investing, right? Uh, s- you must understand that volatility is a sign of life. You need to be in for the longer haul. Uh, SIPs and systematic transfer plans are the best way to go about deploying your capital into an asset class as volatile yet rewarding as equities, and stay in for the long haul. For when we asked Vishal about whether now's a good time to invest in equities, because it seemed peaked to most of our viewers and investors who wrote to us. So Vishal also shared the opinion that you never know what is the peak or the bottom, right? So it is always a good time to invest. And today, if you feel that you have money to invest and you have the intent and the ability to invest, you must invest, because tomorrow is going to be better, and 10 years, 15 years, 20 years down the line, the state of affairs are going to be even better. So please, do not be wary of taking the plunge. Just ensure that you stick to financial discipline, asset allocation, and optimal diversification, and you'll be good to go. So this was Vishal Kapoor of IDFC AMF, and it was an outstanding conversation. We are going to be back with another episode of the Fisdom Wealthcast with yet another interesting guest in the coming week, most probably same day, same time, just another date. So see you guys really, really soon, as soon as next weekend. And meanwhile, happy investing. Don't forget to like, share, and subscribe. Share it with everyone that you love and you want to help. And also hit the subscribe button so that you are continuously updated about every wealthcast that we come up with. Also follow Fisdom's social media handles over LinkedIn, Twitter, and Facebook. This way you'll be continuously appraised of all the new and exciting things that we keep coming up with. So have a great Friday, and happy weekend, guys. See you around really, really soon with a very interesting guest and an interesting conversation next week. See you guys. Happy investing.